自从这个星巴克被博裕资本收购啊，也就一周前的事儿啊。
Ever since the Starbucks was acquired by Buyout Capital, which was just a week ago, I've noticed some big changes. Now they're playing Chinese songs here. This is probably the first major change since the acquisition, and the volume is pretty high too. It's like they want you to drink up and leave quickly. They're already pushing for efficiency, starting to make money. Look at McDonald's after it was bought by CITIC. Now, all the workers are middle-aged women, right? There's hardly any young people anymore. It's all about cutting costs, right? And the hygiene isn't great. Plus, they keep rolling out new items like soy milk and fried dough sticks. I feel like Starbucks is just getting started with this whole Chinese music thing. Soon, you'll see the staff here will all be middle-aged women too. And looking at the menu, I bet they'll have soy milk too. I'm making a prediction right here. Soy milk will definitely be on the menu. With these three moves, Starbucks is changing, and it's going to expand to smaller towns. This is what happens when Chinese capital takes over. Let's wait and see if I'm right.
On November 4th, Starbucks announced it would sell 60% of its business in mainland China to the local private equity firm Buyout Capital. Surprisingly, just a few days later, the stores had completely transformed. The usual light Western music was replaced by high-energy Chinese pop songs, cranked up to the max. It's a clear get in, get out strategy. Drink up and leave quickly. The topic, what happened to Starbucks' new playlist, even trended on November 11th. Many longtime customers said that the vibe was gone, and the cafe now feels like a small-town milk tea shop. Those who used to hang out in Starbucks pretending to work might not find the cafe a refuge anymore. As predicted by one netizen, next the menu will probably include hot soy milk and fried dough sticks. People are getting creative with their jokes. Who would have thought fried dough sticks would pair with coffee? Fried stinky tofu has to be next. Next month's menu, Sichuan-style latte, Westlake vinegar fish mocha, and oil-splashed spicy American coffee. Coffee should come with pancake wraps. This is what we call reverse competition. Starbucks was aiming at their competitor Luckin Coffee, ditching the high-end equipment for mid-range stuff, slashing prices, heavily discounting delivery, and serving food lightning fast. With the economy in decline, they're targeting the low-end market. Some netizens warn foreign capital is pulling out like crazy, so get ready for Commune Food Stamps 2.0 in the near future. Starbucks also revealed that in the future, it plans to expand its stores in China to 20,000, which means there will be more than 7 Starbucks stores in every county town. Analysts say that with an average price of over 30 yuan per cup, this will be hard for county towns to absorb. Even low-end brands like Coty Coffee are facing growth bottlenecks. If Starbucks tries to push this, they'll have to dramatically cut prices. But Starbucks' cost system doesn't support such a massive price cut unless they change the operating model. However, some netizens question, if the business model changes, will Starbucks still be Starbucks? Or does China really need so many Luckin coffees? After Starbucks' makeover, Burger King followed suit. On November 10th, the parent company of Burger King, Restaurant Brands International, RBI, announced it would sell about 83% of its China operations to the Chinese asset management firm, CPE Yuanfeng. This marks a major localization adjustment after Burger King's 20-year presence in the Chinese market. CPE Yuanfeng promised to double the number of Burger King stores in China from the current 1,250 to around 2,500 within 5 years, and expand to at least 4,000 by 2035. CPE Yuanfeng has invested in several consumer service companies, including Mishra Ice Cream, Aier Eye Hospital, Laopu Gold, and Pop Mart. Recently, there have been market rumors that Coca-Cola, the owner of Costa Coffee, is now considering selling the brand. The initial valuation is reported to be around 11 billion British pounds, far below the 3.9 billion British pound price Coca-Cola paid for it in 2018. Centurium Capital, a major shareholder of Luckin Coffee, is reportedly assessing a bid to acquire the entire Costa brand, although the deal structure is still undecided. Centurium Capital, founded in 2017, holds a 31.3% stake in Luckin. Costa, established in 1978, is the largest coffee chain in the UK, with over 4,000 stores globally across more than 50 countries. Costa entered the Chinese market in 2010. As of November 7th, Costa had only 389 stores remaining in China, primarily located in first-tier cities like Shanghai, Beijing, and Guangzhou. In terms of store count, Costa ranks about 12th in the Chinese market. Additionally, on November 6, Yum Brands announced that it has begun a strategic review of Pizza Hut, which includes a potential sale. Meanwhile, Haagen-Dazs, known as the Hermes of ice cream, signaled back in summer 2025 that its parent company General Mills plans to sell its Chinese store operations, with a potential valuation in the hundreds of millions of dollars. From early 2024 to mid-2025, the brand closed about 80 stores in China, reducing its national store count from a peak of 466 to around 385. In August, media reports indicated that French sports retail giant Decathlon is planning to sell about 30% of its stake in its Chinese subsidiary, with an initial estimated value of 1 to 1.5 billion euro. Decathlon China has not commented, but the rumors are not without basis. Since 2022, Decathlon's performance in China has been on a steady decline. Several large stores in Beijing, Shanghai, and Guangzhou have either reduced their space or closed. The 2024 financial report showed Decathlon's China's net profit plummeting 15.5%, hitting its lowest point in nearly 4 years. Swedish furniture giant IKEA's parent company, Inca Group, has also been rumored to be selling 10 of its shopping centers in China. Market rumors suggest that the first batch of projects in Wuxi, Beijing, and Wuhan, worth about 16 billion yuan, will be acquired by a fund led by CTBC Life Insurance, although this news has yet to be confirmed. The reason for these sales is financial pressure on the group. For the 2024 fiscal year, its net profit dropped by 46.5%. IKEA China sales in 2024 were about 11.2 billion yuan, nearly 30% lower than the 15.8 billion yuan in 2019. Despite increasing the number of stores from 29 to 39, the sales per store dropped by more than 40% year-on-year. This wave of withdrawals from the food and service industries, while influenced by geopolitics, has to factor in the ongoing sluggishness of China's economy and the continued downgrade of the consumer market. Younger consumers are favoring extreme frugality. The restaurant and retail sectors have been the first to fall into a collapse. Taking the coffee market as an example, local emerging brands like Luckin Coffee and Cotti Coffee are rapidly expanding. They're gradually encroaching on the territory of foreign giants. Luckin's 9.9 yuan per cup strategy is a prime example of this trend. This dramatic shift in competition has caused Starbucks' market share in China to plummet from a peak of 42% in 2017 to just 14% in 2024. However, as netizens have feared, after these foreign brands are sold to Chinese companies, they're likely to quickly localize and join the internal competition wave. The consequence of this is that consumers no longer experience the unique atmosphere these foreign brands once offered. Instead, they will face a more homogenized battle for price cuts model. The high-end ambiance phase, replaced by cheap takeout, fast food innovations, and the proliferation of local flavor stores. In the midst of economic downturn, foreign companies selling out may be a self-preservation move, but for consumers, this means not only a change in brand identity, but also the quiet disappearance of a certain lifestyle. This wave of foreign companies withdrawing from China is not limited to the food and beverage industry. The exodus of foreign firms in the technology and service sectors has been even more rapid and decisive. On November 4th, American software company SAS Institute made a swift exit from China, laying off all 400 employees and requiring them to sign a termination agreement by November 14th. This marked the complete withdrawal for the tech giant, which had operated in China for 25 years. On October 16th, Jensen Huang, founder and CEO of NVIDIA, stated in a conversation that due to U.S. export controls, NVIDIA has fully exited the Chinese market, with its market share in China dropping from 95% to 0%. In March, IBM further announced the closure of its Chinese subsidiary and its branches. This followed last year's closure of its R&D department in China, a significant step that further solidified the decoupling trend. Recent reports also indicate that General Motors has instructed its thousands of suppliers to gradually eliminate Chinese-made components from their supply chains. According to sources cited by Reuters, GM executives are urging suppliers to develop alternate solutions for raw materials and parts, with the ultimate goal of completely eliminating reliance on China. Some suppliers have set a deadline of 2027 to sever ties with Chinese procurement. This move is expected to impact tens of thousands of upstream component supplier jobs. Additionally, BMW saw a 20% drop in sales in the third quarter and has shifted some electric vehicle production to its factory in Vietnam. It it did so to avoid price wars with local EV giants like BYD. Micron, a major U.S. semiconductor company, stopped supplying server chips to Chinese data centers in the first half of the year. Dell continues to shift its laptop production, aiming to relocate 30% of its production capacity to Vietnam and Mexico, while reducing its dependence on Chinese chips. Since the beginning of the year, foreign enterprises have been accelerating their decoupling strategy, affected by the escalation of the U.S.-China trade war, slowing economic growth and increasing local competition. According to the 2025 China Business Report, released by the American Chamber of Commerce in Shanghai, only 41% of American companies remain optimistic about their business prospects in China over the next 5 years, marking a 4-year low. Only 12% of American companies consider China as their top investment destination for headquarters. More concerning is that on November 7th, the State Administration of Foreign Exchange released its third quarter 2025 balance of payments data, showing that foreign direct investment into China amounted to just $8.5 billion US. This figure consists of $14 billion in equity investments, minus $5.5 billion in adjustments for affiliate debts. This represents a 51% quarter-over-quarter decline and an astonishing 92% drop compared to the peak of $103.9 billion US in the first quarter of 2022. In other words, in just 3 years, this figure has shrunk to less than 1/10, hitting its lowest point since 1990. This data reflects the collapse of foreign investor confidence, marking a historical reversal for China. It used to be a sweet spot for global capital, but now it's a high-risk destination. The balance of payments data shows that this decline is not sudden, but rather a continuation of a gradual collapse. In 2021, foreign direct investment net inflow was $334 billion US, dropping to $108.2 billion in 2022, further shrinking to $42.7 billion in 2023. In 2024, it was only $18.6 billion. While the first 3 quarters of 2025 show a net foreign direct investment inflow of nearly $32 billion US, the key will be the fourth quarter. Given the current trends of foreign companies continuing to sell equity, shift supply chains, or even shut down completely, some predict that the year would see a net outflow. This year, the pharmaceutical and healthcare industries have seen the most intense foreign exit. In addition to the effects of the trade war and geopolitics, the Chinese government's centralized procurement system for medical reforms has caused prices to plummet, coupled with fierce competition from the local pharmaceutical industry. This has led to a wave of collective withdrawals by foreign pharmaceutical companies. For example, in July, British pharmaceutical giant GlaxoSmithKline, GSK, sold off the remaining 12% of its joint venture with China, ending nearly 40 years of partnership. At the same time, products like the generic version of asthma medication, Ventolin, were filed for deregistration in October. On July 31st, Japan's Sumitomo Pharma announced it would sell its business in China and Southeast Asia. This marked the company's official exit from China after 30 years in the market. On October 15th, the China National Medical Products Administration announced the cancellation of more than 80 drugs, more than half of which were foreign or joint venture products. This means that these already imported medicines will completely exit the domestic market. In fact, by 2024, China had already ceased registering 161 types of imported drugs. At the same time, since December of last year, the Chinese authorities published a list of nearly 200 pharmaceutical companies, public hospitals. People have noticed that almost all of these manufacturers are domestic generic drug makers. This might send a clear signal. Imported medicines will be much harder to obtain in the future. Due to a lack of trust in domestic pharmaceuticals, many netizens in China have begun looking for overseas channels to purchase medicines, with Southeast Asian countries becoming their first choice. The proximity, affordable travel, and competitive drug prices make it even cheaper than purchasing branded drugs in China. Regarding the collective withdrawal of foreign pharmaceutical companies, an industry insider shared a high-level perspective.
Let me share my top-level understanding of the situation. Once you grasp this point, many things will make sense without much thought. Why are foreign medical equipment manufacturers leaving or abandoning the Chinese medical market? Companies like BD, Siemens, and recently GE. Who would have thought this would happen? After all, many engineers in China came from GE. You need to understand what the largest background of the Chinese market is to understand the logic of foreign companies. The largest background of China's market is a planned economy based on national policy. It doesn't operate through the market. Instead, money is allocated by the authorities to specific areas. This is why the US has never recognized China's market economy status. So, what is China's national policy? It's domestic substitution. The domestic substitution policy gives foreign companies 10 to 15 years to make money. But that time is getting shorter and shorter. During these 10 years, we accumulate rules and technology. Even if they have to sacrifice profits, they will eventually be pushed out.
He also explained that this logic applies to the automotive industry as well, explaining why Western car companies are increasingly struggling in China. Beyond China's electric vehicle strategy, aiming to counter US dollar dominance and oil dependency, the key issue is the difference in profit models. Western car companies focus on the consumer wallet, making money through market sales, while Chinese car companies in the early stages are driven by policy money. Government funds are directed into a reservoir, and the fewer the players in the pool, the more subsidies and orders are available. This also leads to a phenomenon in emerging fields like healthcare, where profit margins are low, but companies still aggressively slash prices. Because of policy favoritism, domestic companies are emboldened, and foreign companies' efforts have been destined to fail from the start. On the surface, it seems that foreign companies are exiting because they can't adapt to the Chinese market, including its strict regulations and fierce price wars. But the truth is, from the beginning, China's policy design never intended for them to adapt long-term. There's always been an intention to push them out. This is not just a reflection of the medical equipment sector, but the invisible ceiling on the entire foreign business layout in China. So, the entry of foreign capital into China was never a simple win-win cooperation, but rather a carefully designed trap. First, using low-cost labor, a huge market, and favorable policies to fatten up foreign companies. The government allows them to invest, transfer technology, and embed into the industrial chain. Then, through tightening regulations, forced joint ventures, and intellectual property plundering, the foreign companies' weaknesses are exploited to extract surplus value. Finally, through domestic substitution and geopolitical pressure, they're killed off by being forced to sell assets at a low price or completely withdraw. This is not a market failure, but rather a reflection of China's planned economy plus state capitalism model. They view foreign capital as temporary cash cows, which are milked and then slaughtered. The 92% drop in foreign direct investment in 2025 is a manifestation of foreign capital waking up. This serves as a warning to other foreign companies still operating in or planning to enter China. Don't fall for it. China's market is not an opportunity, but a trap.